What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a different approach here, not looking at any individual security, but taking a look at the market as a whole, especially now with the market hitting all-time highs. There is an imminent market crash that is incoming. It will cause a doomsday scenario for investors and the market as a whole. It is exactly what the business, financial news networks, and mainstream media outlets, more importantly their guests, are spewing onto us, stating the obvious. Yes, markets are at all-time highs. Yes, the sky is blue, but this information is irrelevant to us. They are essentially laughing in our faces, hoping that we would be panic sellers so that they can purchase our assets at lower multiples and prices than where the current market prices are today. My goal in this video is to present to you some historical evidence that backs up the claim that this is all noise and these gurus are gurus of nothing. Now, I'll start with this chart from Vanguard. I believe it's a very important chart here. It takes into account a 45,000 British pound investment through lump sums that we can see on those dots on the turquoise line graph. And you can see that 45,000 pound through a variety of lump sum additions grew to 197,963 British pounds. This is a time frame from September of 1997 to February of 2026, not accounting for the route that we've seen post February 2026 in all major indices globally. But this is a very telling story. If you invested these lump sums at all-time highs through the dot-com crash, the 9/11 crisis, the global financial crisis, which happened over the span of a few years, and when you look at those news feeds and you read those articles back during that 2007 to 2009 timeframe, one of the funniest articles, in my opinion, and newscasts was the live feed of the Dow dropping 100 points at the open. It was a big story generator. And now you look at it in the market in 2026, if we don't have at a minimum 100-point swings either on the upside or downside, in fact, even 200-point swings on the Dow, we actually consider that a low or extremely low volume day. So you can see how markets have grown from that time frame. Even if you do a lump sum addition right before the COVID-19 sell-off and pandemic, remember that was fun. Or even during the US tariff announcements when we were tariffing the poor penguins, the market continued to generate positive returns and outpace cash returns. In this case, that orange line there is cash and short-term investments. And you can see that 45,000 pound growth difference between these two values. Obviously investing at all-time highs, and investing at all-time highs on the S&P 500, especially in this graph here, occurs many times over a decade. I will mention in that 2020s graph that we see at the bottom there at 181, this year alone, we've had 27 all-time highs. This is a cutoff as of August 2025. We've had 27 all-time highs. Even towards the end of 2025, we reached more all-time highs. So this value of 181 is actually closer to the 1960s level. Again, if we go back just to this chart here, there's been many all-time highs. And as investors, we want to see our investments grow on a graphical scale from bottom left to top right. And in order to do so, throughout the way, we will continue to hit all-time highs. That just is inevitable with growth in any asset. So investing in all-time highs, you look at any time frame in this graph here, whether it's the 50s, 60s, 70s, 80s, 90s, 2000s, 2010s, or even the early 2020s, the market is still higher than where it was during that time frame. And something that I hear a lot as well is, well, Mr. Finance Bro, you see 2 big decades of all-time highs and good growth, and that's preceded by a 3rd decade of essentially lower returns and lower all-time highs reached. And yes, that is the case in terms of this information here from the 50s to today. We are currently in a later half of this decade in 2026. If this argument was to even have any standing, not entirely sure if anyone knows what's going to happen in the 2030s, let alone in 2030, 4 years from now to 14 years from now. If you do know, you can gladly have my money to invest because you have some sort of crystal ball that nobody else has. So investing in all-time highs is normal and is just the normal mechanics of a well-functioning market. And even here, this is, I believe, a very good graph from Bloomberg and RBC. If you invested in that dark blue there only at all-time highs on a 1, 3, and 5 year basis, or you just stayed invested in that yellow line, you can see on the 3 and 5 year returns, there is a less than 1% discrepancy from investing only at all-time highs and staying invested. So inevitably, what this means is no one can time the market. Even if you attempt to and you fail miserably and invest only at all-time highs, you still generate double-digit positive annualized returns. Obviously, staying invested produces better returns with less stress. And this is what I was talking about earlier, that there is an imminent market crash coming. For some reason, investors and speakers of the market, I will call them, will always say whenever we hit an all-time high, a crash, for some reason 10% is the number, a 10% crash is imminent. Well, we look at that in these charts. 1 year out from peak to trough of an all-time high to market bottom of greater than 10% has only occurred 9% of the time. 3 years out, only 2% of the time, and 5 years out, that has never happened. So not entirely sure where the basis of this argument comes from. Yes, markets will hit all-time highs. An all-time high doesn't mean a crash is inevitable. I wish life was that easy. Once things go up, they'll come back down, and then once they come down, we'll hit a bottom and it bounces right back up. Fortunately, the market will punish you for thinking that way, and the data backs that up. And this graph here, I believe, is very important. This is a $10,000 investment starting in 1973 to 2023, not accounting for the post-market growth of 2023, where the S&P alone is up almost 80% from then until now. Obviously, staying invested turns that $10,000 investment into $378,434 US dollars. But what's very important here is the returns and missed growth that investors receive for missing the 10 best days in the market. You can see here, missing 55% growth, missing the 20 best days results in 74% missed growth. And in all honesty, if you're missing 30 plus of the best days in the market, trading's not for you. Hang them up, stay invested, or stay in an index fund to save yourself the headache and the trouble. And the reason for this big discrepancy is on recovery days through market troughs, those are the best days to be invested. The volatility on the upside benefits long-term shareholders, and it is a very vicious recovery when we come out of any crisis, whether it's a short-term crisis like the tariff announcements, a longer-term crisis like GFC in 2007 to 2009, or even the pandemic. We did see sharp recoveries, and that is where you hear that term, the V-shaped recovery. If you're on the wrong side of that V, you will be punished heavily, both on an opportunity cost side, and if you're short the market, well, good luck to you. And I always call people who try to trade the market gamblers, because inevitably what you are is a gambler. You are taking a gamble on the direction of the market on the short term, because the odds don't favor you trading longer term. Look at that just on a monthly basis. 64% of the time on a monthly basis, the market has produced a positive return. Again, this is taking over a 50-year time frame, but that's a lot of data to accrue. On a 1 year basis, 76% of the time, the market produces a positive return. And you can see that on a 3 and 5 year basis as well. And 10-year basis, it's almost perfect. The odds are not in the favor of traders. So with all this information, not entirely sure why people choose to trade and think that they have some sort of crystal ball that the market itself doesn't have. If you do think that, well, not only will those individuals that I talked about earlier on those news networks laugh at you, but I will as well, because traders at the end of the day who believe they know the short-term direction of the market are clowns, and clowns get punished heavily in our markets. So I do thank you guys for making it to the end of this video. Again, this is not investment or financial advice, solely for entertainment purposes. I do appreciate it if you guys hit that like and subscribe button, and stay tuned for the next video.